Good morning, ladies and gentlemen. And firstly, I want to thank ULI, which, for my sins, asked me to speak about the situation in Russia in 7 minutes. I was actually reminded of a story which illustrates my predicament, which back in 1991, thank you very much, when Russia was still a young state, John Major came to support the newly elected President Yeltsin. And he was told that Mr. Yeltsin, in fact, was extremely busy. There was a lot of problems to deal with in Russia at the time. And when there was a meeting, John Major was thrust into a room full of people, and Yeltsin stood up. And Major asked him, well, President Yeltsin, I understand you have very little time, but can you tell me in one word, what is the situation in Russia? Yeltsin looked at him and said, good. Major was not satisfied with that answer, and he pressed. He said, well, Mr. President, perhaps in 2 words you can say what you feel is really going on. Yeltsin thought about it, and he said, not good. Well, it's hard to believe that in this room, 12 months ago, the major conversation when oil was at 115, the major conversation about Russia centered around the budget of the Olympic Games and whether there will be any snow. That was the most contentious conversation. And it's hard to believe how much the circumstances of the last 12 months have thrust the country and its real estate market into what many call a perfect storm. In fact, if we ignore the systemic issues, then the consensus is about 60+% of the Russia's economic problems today stem from the drop in oil price, and about 40% from the sanctions. Indeed, several economic indicators, like investment in fixed assets, have suggested that broad sectors of the Russian economy have been in decline and recession already in 2013. Yet the high oil price was like the proverbial high tide, masking those swimming naked. Before I move to the silver lining slides, which I have, let me tell you a line that you often hear now in the boardrooms in Moscow. It goes something like this: smile because tomorrow will be better than the day after tomorrow. Now to the silver linings. There is an old Chinese proverb about seeing challenges as opportunities. And this captures perfectly the view that we have of the market at the moment. You may argue that investment in fixed assets like windmills at this time may sound reckless, but do something, bring a kite. In fact, flying a kite in thunderstorms have proved to be leading to significant discoveries. If there is one word that people use to describe investment in Russia and the reasons they do it, that one word is potential. And there are 5 ways in which I would like to describe what that means to me today. One is, although its wealth has diminished, Russia still remains the middle-class brick. And here, to Eric Chanet's earlier point, Russia compares favorably to the developed world, particularly in Europe, in terms of ratios of household, corporate, and government debt. And I don't want to sound dismissive, but the downgrade of S&P of Russia earlier this month was done by the same entity that downgraded the US in 2011, and the same entity that gave investment grade to junk bonds in 2007. So the next point, in fact, is very important. Several multinationals in Russia still come out in 2014 as world beaters in their companies globally in terms of revenue, profits, or both. One regional president of a global confectionery company told me that in 2012, prior to the slowdown in Russia, sales were equal to those of France and Germany combined. But currently the Russian market is only equal to the size of the French market. That, I would say, is still not bad. Many global firms operating in Russia use it as a testing market for new concepts before rolling them out to the rest of the world. I mentioned the example of Adidas in our council meeting yesterday. Perhaps the key for many of us is the abundance of legacy Soviet infrastructure. And this means a requirement and not a preference for the country to literally rebuild itself, to be fit for a modern economic purpose. There are four elements, there are four trends or game changers, the things that are often overlooked, which I want to mention next. One is trust. Trust seems, especially now, as a scarce commodity in Russia. Yet there are many examples of solid local joint venture partners and partnerships which endured and prospered, both in boom and bust times, of which we've had a few. Davos Forum, in fact, remarked last year, as a point number 2, that the pale performance of GDP of Russia as a whole masks extreme outperformance of certain regions like Moscow, Kazan, Vladivostok, which are just 3 of 85 regions which make up a federal country of Russia. And then, of course, an important element is the cadre of 35 to 45-year-olds, Western educated, successful, wealthy as ex-business owners, which are actively recruited into government today. And they're helping to create a different dynamic, a new dynamic of technocratic administrations, not everywhere, but in some places, which we have never seen before in the country. And then finally, new money from China, Korea, Central Asia, Middle East, is starting to look to replace Western capital, which was actively competing for deals in 2012 and 13. Now, given eminent Greg Clark leading this, moderating the session, and Chris Choa, who I think is in the audience, and Alex Note, and many others who are here, I could not leave out the story of Moscow's own urban transformation, which is only 4 years old, by the way, and which started in 2011, appropriately with a ULI advisory panel assembled at the request of the new Moscow city government at the time to tackle some of the most urgent development challenges. The outcome of this advisory panel and the first Moscow Urban Forum in 2011, which ULI supported, became the foundation of Moscow City Development Strategy, Moscow 2025, which was adopted in 2013. This way, ULI actually played a key role in directing, in some ways, towards infrastructure, at least, the budget of a city which is 5 times greater than the budget of the city of Paris. And this is not a small task, ladies and gentlemen. In closing, perhaps the last remark would be, and the one that's, in my view, an extremely important one to know, and this is the one you're not going to see in the front pages of FT or Wall Street Journal, is that the property market in Russia is seen by local investors, and they make up 90% of the volume and activity there, as one of the few truly independent, free from government interference sectors of the economy. And as such, even in tough times, as today, the real estate sector enjoys disproportionate amount of attention and liquidity. With this, I thank you very much, and I pass over to Greg.
Sergey, thank you very much. Reasons to be optimistic about Russia. Henry, please talk to us about China.
Thank you, Greg. Well, actually, I'm only chairman of mainland China. Now, even that is a bit too big for me. But when we talk about China economy or economic growth, my personal feeling has been a bit like sort of looking at a painting by Picasso or something of that sort. Different people may see different things and may have different views. The common terminology that we hear from the West describing China economy or economic growth is one, fast or slow, or high or low. But in China, the terminology we use is quality. Quality growth is what we've been talking about. In Shanghai, China's biggest commercial city, this year's government plan has no GDP growth target. We just talk about the quality of growth, not the quantum of growth. And how are we going to go about achieving quality economic growth in China? in December last year, after the Central Economic Meeting, President Xi issued a report on achieving quality growth, and I think it sums up to the main theme of what he called the new normal, the meaning that what was not very normal and now become the norm. And and the way I look at it, in my 21 years of living and working in China, that is probably the first systematic reflection of the past, particularly the past 20 years, with the opening up and reform policies, and a very specific direction for the future. And also my own view is that understanding coping with this new normal is vital to the sustainability of business in China. And I sum up President Xi's report in sort of 9 major domains of new normal. And the first part of his report is domestic consumption. And for obvious reasons, the 3 engines of growth in China, investment, export, we know what's the situation. So the main thing is promoting domestic consumption. But how are we going to promote? And it sums up to personalized and diverse product and services. Underline the word personalized. There's a lot to say about overbuilt in China. The problem is that in absolute terms, they're not huge. But the problem is that they're all the same. So we end up with a dogfight. Number 2, investment. The report specifically highlights the enormous opportunities in integrating traditional business with new technology, new products, in new services, and new modes of operation. And to me, this traditional business is the real estate business. Number 3, product and capital flow. And for the first time, the president is beginning to talk about capital growth, capital flow. In the past, we talked about products, import and export, but now we talk about inflow and outflow of capital. Production capacity and organization, consolidation. It's been right. This has been. Sorry. So next. It's not working. Is that the one?
That's the one, Henry. I think Victoria's going to give that a go for you.
Okay, yeah, I can continue. So that is not included in my 7 minutes, right? So
you want some quantitative easing here?
Yes, yeah. Yes. Time out. Okay, yeah. Okay, where were we? Yeah, production, capacity and organization. Consolidation, mergers, and acquisition will be inevitable. I was talking to Andrew, our friend from Mayor Brown. There's a huge business for legal professions and also accounting professions for the mergers and acquisitions. Number 5, production capability, quality people, and advanced technology. We heard about it this morning, will be vital ingredients for growth. Competition, quality and differentiation become the key competitive advantage. We at Chongbang, we thrive on differentiation. We've been talking about it and doing that for the last 20 years, and we're so glad that for the first time, the president is now talking about competition by differentiation. Environment, people are demanding better living environments, and, well, the president didn't say it, but environment include a clean political environment, and that is the anti-corruption campaign is going on, is all about. Economic risk, beware of economic bubbles, and gearing become increasingly dangerous, and business must develop systems to control and manage risk. So in our company, in operating China, we make a rule of thumb that is we will never leverage over 40%. Resource allocation, demand and supply must be analyzed and regulated systematically. 10 years ago, we said that we will not build shopping malls which are smaller than 100,000 square meters because there wasn't a 100,000 square meter shopping mall in those days. But now, there are 100,000 square meter shopping mall everywhere. So why should we be building 100,000 square meter shopping malls? So resource allocation, demand and supply, we have to look at. From here on, it's from me. From the new model, from the new normal, we believe that comes the new models. And to cope with new challenges, opportunities, we'll need new business models, and new business models will comprise, is my personal opinion, new concept, new technology, new product, new service, and new mode of management and operation. And most important is that the design and execution of new models must take into consideration the market timing and the business own capabilities. We just cannot borrow successful stories from the US and from Europe. And if we do it right, under the new normal, business will either flourish or perish. But that may be a bit of an overstatement for some business, but at least for my business, which is retail anchor mixed-use projects, is definitely true. Yeah, if we cannot understand and cope with the new model will either flourish, become bigger and stronger, or perish. And if we do it right, dragon in the sky. And the sky has no limit. Thank you.
Henry, thank you very much indeed. It's now a great pleasure to introduce ULI's worldwide chairman, Lynn Thurber, who's going to talk about the USA.
Thank you, Greg. As I wandered through the newsstand in the San Francisco airport Sunday afternoon heading in your direction, I saw that there was one last copy of the FT Weekend US edition sitting on their counter. And the news article headline on the left-hand side caught my eye. Weak exports undermine US recovery hopes. 22 quarters of consecutive GDP growth, and the headline is about recovery hopes. So I read the 8 lines of column that talked about all of the headwinds we face, the issues of lower oil prices, reduced government spending, weak Europe. And I thought, oh my gosh, it is true that the media far prefers the bad side of the story. And then I finally got down to the small print at the very end of the article, where there's another headline and a reference to a story deep in the middle of the paper, reasons to be cheerful. So I wanted to share with you today our views on the fact that the US is still, for the next 2 years, going to have strong growth, certainly relative to the rest of the world, and why we see that the tailwinds, in fact, will overcome the headwinds and prevail despite media attention. We really do see a promising outlook for real estate fundamentals. The office recovery has accelerated and should outperform in 2015. Construction remains below average in all sectors except for the apartment sector. Core pricing is likely to stay high, but the strong fundamentals and capital flows are likely to support this current pricing. But it means for all of us who are owners and investors that we are going to have to search harder to find the right opportunities for having adequate return for the risks we're taking. And for LaSalle, our views are that we look at what we call the DTU themes. And you heard some of that from Eric this morning and in Peter's introduction. Demographics, technology, and urbanization are places that I'll get to in a few minutes where we're finding investment opportunities with those appropriate risks and return. So very quickly, just going through the economic backdrop, certainly we did see that the Q4 numbers were lower than expectation on GDP growth at 2.6% for a full year of 2.4%. That should not take away from the fact that that was about expectation if you went back to this time last year, and that the 5% in Q3 was a very strong quarter and should not be forgotten. And so you can see our projection for the future years, certainly for 2015 and 16, continues with moderate growth, but still on the growth side. Supporting that has been 2014 as the strongest year for job growth in 15 years. Employment grew by a solid 250,000 jobs in December, giving us the 11th consecutive month of job gains over 200,000. So, as Eric commented, we are down to unemployment at about 5.6%. So we are well down to what we expect to be a level that is going to see wage increases starting now. And that is going to further support the consumer, who makes up 70% of our GDP numbers. Job recovery is certainly differentiated by marketplace, but as you can see from this slide, in almost every market that any of our investors consider, we have not only recovered back beyond the pre-recession numbers, but there has been good growth beyond that, and the final markets at the bottom are close to getting into that dark blue category that's showing additional jobs beyond the 2007 numbers. Certainly, reduced oil prices, although it appears that Monday and Tuesday have given us a little bit of bounce back in the oil prices and some good numbers coming out of Exxon. We're going to see some impacts on the energy sector and the markets that depend on the energy sector. In the US, those states are California, Texas, Alaska, and North Dakota. I don't think many of you are investing in Williston, North Dakota, so probably the most important one is Houston, and we are seeing some softness there, and certainly LaSalle has been in the news for moving back from a major office acquisition that we had under letter of intent. Interest rates at the very beginning of this year, just like the last 2 years, the forecasts were very varied and for some material increases. But the gray bar in the 15, 16, and 17 graph is in fact the numbers for the yield forecast in the futures market, and those are much more where we think the market is going to be, lower, longer. The Fed is sticking to its story that it's going to raise interest rates in June. They may. We don't expect it to be much, but we also are skeptical that it will happen that quickly. Additionally, the good news is that we are still 60 basis points above the historical average spreads between the income yield on real estate and the 10-year Treasury. That gives us still some movement for attractive returns, and we would expect with interest rates at the 2.25% to 2.5% at the end of the year, we will still look at very favorable returns. In addition to that, we see transaction volumes very strong. 2014 was a 12% increase. We expect a similar type of increase this year. This may make you a little nervous, as it does me when I see the 2015 forecast at the same level as we all experienced in 2007. And in 2007, we certainly gave all the reasons why those capital flows would continue, and that there was no reason to be concerned about this flow of capital underlying and supporting our values and prices in the real estate market. But that bubble question earlier to Eric, we can't see any of the indicators either on a downturn or on a bubble that would give us pause in 2015 and 2016. All the things that we've been concerned about in the past just are not on our horizon at the moment. Turning to the property markets, we certainly are seeing strength in the fundamentals. We have seen continued decreases in vacancy, and as you see on this chart, in every sector except for suburban office, we are now below the long-term averages on vacancy, with strong decreases in vacancy last year, with the exception of apartments. And apartments is strictly new construction coming on board, and we're seeing strong demand. And so that in turn has turned into rental rate increases in all property sectors. Which one should you invest in? For us, there isn't a lot of differentiation between these property sectors for 2015. Short-term, CBD office may look like the strongest. However, we would say medium-term, we are very concerned about the capital expenditures required for office in order to pay for leasing commissions and cap the tenant expenditures. And when the next downturn comes, when it comes, which it will, we know that the CBD office is one of the most volatile. So in the short term, it looks like office is going to be the return high of the year, but we would be very careful not to overweight. As we turn to where those themes are for the coming year, as I mentioned, and certainly in Peter's opening comments, the demographics, what the millennials are looking for, what the baby boomers are looking for, is absolutely crucial in where we look to invest. And one of the results of looking at those two cohorts is where are they living, where are they working, where are they recreating? And in every one of the markets that our institutional investors look at today, the city, the CBD, is growing in population much faster than the broader MSA. And so we are very focused on those inner cities. On the technology side, certainly technology has been a driver of growth in the United States, a driver of employment. However, when we look at them, we realize that that is well recognized, and Silicon Valley and Boston are very fully valued. So we need to find out where are the next tier of tech markets appearing, where's the emerging tech markets and the potential tech markets. So we move from Silicon Valley and Boston and look at places like Minneapolis, Pittsburgh, certainly River North in Chicago, or NoHo in New York. And finally, niche strategies we expect to provide good returns for the risks that you take in looking at areas like medical office, public storage, parking garages. Strong income should weather very well throughout another downturn. Some of you may look at this picture and think this is a picture of the storm coming. Many of you know that I live in Montana. And for somebody who lives in Montana, big sky country, I see blue sky overhead. I see prevailing winds from the west keeping those clouds at bay, and a great day for going out and having some activities. But mind you, on my iPhone, my dark sky app is always turned on, warning me if any of that rain is going to land on my hike. Thank you.